In late 1999, a strange thing happened. People stopped asking what a business earned. They started asking only one question. Is it going up? That is not investing. That is heat. And when enough people chase heat, the market starts to act like a bonfire. Bright, loud, hard to look away from, and very easy to get burned. The dot-com bubble did not start with bad people. It started with normal people who wanted a better life. They saw new technology. They saw new internet companies. They saw prices rising every week, and they started to believe a dangerous idea. They believed that price was proof. They believed that if something keeps going up, it must be safe. They believed that if everyone is doing it, it must be smart. They believed that if they don't join now, they will miss the only chance. That is how FOMO becomes a financial plan. And when FOMO becomes the plan, you stop thinking like an owner. You start thinking like a crowd. Now, here is the part that makes this story worth studying. One of the most famous long-term investors did not join the party. He watched the same headlines. He saw the same charts. He heard the same new era talk. He saw people getting rich fast on paper. And he still refused to chase it. Not because he hated technology. Not because he was against change. But because he refused to play a game where the rules were made of hope. In plain words, he warned that people were taking fire-level risk. He warned that when you pay any price, you are not investing. You are guessing. And guessing works until it doesn't. This video is about that warning. Not as a history story. As a skill. Because the dot-com bubble is not just an old event. It is a pattern. The names change. The apps change. The stories change. But the emotions stay the same. Greed, fear, FOMO, ego, panic. And those emotions can break your compounding faster than any bad news. So in this video, we are going to break down what was happening in 1999, why so many smart people still got trapped, and how a calm, boring way of thinking helped one investor avoid the worst of it. And we will build simple tools you can use today, tools like the owner test, the circle test, the price test, the margin of safety rule, and a plan for volatility so you don't panic when the market turns. Because the goal is not to win a headline. The goal is to still be standing after the noise is gone. Now let's go back to that time for a moment. The late 1990s felt like a race. The internet was changing everything. New companies were coming out fast. People were opening online trading accounts like it was a new hobby. Friends were giving friends stock tips at dinner, and a new kind of status showed up. Not what do you do for work, but what did you buy? People who had never read a business report felt like experts because their screen kept turning green, and the market rewarded that behavior for a while. That is what makes bubbles dangerous. A bubble doesn't just raise prices, it changes your brain. It trains you to link action with reward. It trains you to believe speed equals skill. It trains you to ignore risk because risk doesn't feel real while you're winning. And then, one day, the market stops rewarding the behavior. That is when the fire shows itself. So what did the calm investor do instead? He did something that looks weak in the moment, but strong over time. He said no. He stayed inside his circle of competence. That phrase sounds fancy, but it is simple. Your circle of competence is what you understand well enough to stay calm, not what you like, not what is popular, not what someone online says is the future. It is what you can explain in plain words. How the business makes money, why customers stay, what could kill it, what a fair price might be. If you cannot explain those things, you are not buying a business. You are buying a story. And stories are easiest to sell at the top. Now, let's be honest. In 1999, many internet companies were hard to value. Some had no profits. Some had weak business models. Some had huge growth dreams with no clear path to real cash. So how do you value a dream? Most people did not. They just joined the crowd. They used weak reasons like eyeballs, clicks, or first mover. They said things like it's the future, as if the future automatically means a good investment at any price. But a great future for a product does not always mean a great return for a buyer at the wrong price. That is the key. A great company can be a bad investment if you overpay, and during bubbles, overpaying becomes normal. So the calm investor used another simple idea. He separated the business from the price. He did not ask, is this company exciting? He asked, if I owned this whole business, What would it be worth to me? That is owner thinking. Owners do not stare at charts all day. Owners look at cash, costs, competition, long-term demand, and the price they pay. Now here is where people get confused. Think avoiding the bubble means you must be scared. Avoiding the bubble can be a form of discipline. It is like walking past a table of free candy when you know you will feel sick later. The crowd thinks you are missing out, but you are protecting your future. So let's turn this into a simple framework. When the market gets hot, you need a heat checklist. This checklist is not about predicting a crash. It is about spotting danger signs in your own behavior and in the market mood. Here are a few heat signs. 1. You hear people say valuation does not matter. 2. You feel embarrassed to ask basic questions like how do they make money. 3. You see prices rising fast with no clear reason in the business. 4. You start thinking I'll just buy now and figure it out later. 5. You feel pressure to act today because everyone else is acting today. That pressure is the smoke in the room. Most people ignore smoke because they don't see flames yet, but smart people respect smoke. Now, there is another tool tied to this story. Many people call it a market value check, a way to ask, is the whole market getting expensive? One common version looks at the size of the stock market compared to the size of the economy. When the market gets very large compared to the economy, it can be a sign that prices are stretched. This is not a magic alarm. It does not tell you the exact day things will fall, but it can tell you when the room is getting hotter. And in 1999, many signs were flashing, but most people did not want to see them, because seeing risk ruins the fun. That is another hard truth. During bubbles, people don't just make mistakes. They defend the mistakes. They build an identity around them. They don't say, I bought a stock. They say, I believe in the future. And when you question the price, they act like you questioned their intelligence. That is how bubbles trap smart people. So the calm investor avoided a second trap. He avoided ego investing. Ego. Investing is when you buy something because you want to feel right, or you want to look right, or you want to belong. Value investing is the opposite. Value investing is a quiet skill. It is the skill of being willing to look wrong for a while, as long as your thinking is sound. Now, I want you to notice something important. The lesson is not tech is bad. The lesson is not never buy new things. The lesson is do not pay any price, because any price removes your margin of safety. Margin of safety is the gap between the price you pay and the value you believe you get. It is room for errors, room for bad luck, room for slower growth, room for surprises. Without that room, you are walking on ice. You might be fine for a few steps, but one crack can drop you fast. So here is the simple price rule we will use in this video. If your investment only works in a perfect future, it is not safe, it is fragile. And fragile is what burns first when the market turns. Now, let's make this personal, because you might be thinking, okay, but I would not fall for that. Maybe you wouldn't, but bubbles don't ask for your permission. They pull you in through small thoughts. Thoughts like, it's only a little, or everyone is doing it, or I'll sell before it drops, or this time is different. So your best defense is not confidence. Your best defense is a written rule. Here is a simple inner rule you can borrow. When I feel rushed, I pause. Because in markets, urgency is often a trap. If the only reason to buy is that you might miss out, that is not a reason. That is a feeling. Now, what happened next in 2000 is the part most people remember. Prices fell hard. Many internet stocks crashed. Some never came back. Many people who felt rich on paper lost huge amounts. And here is the painful part. A lot of them did not lose because they were stupid. They lost because they broke the basic rules of ownership. They bought what they did not understand. They paid prices with no margin of safety. They let the crowd decide for them. And when the fear started, they did what crowds do. They panicked together. But the calm investor did not panic because he was not trapped. He had not built his plan on hype. He had built it on value, on business quality, on price discipline. He did not need to get out fast because he had not rushed in. This is a huge lesson. The easiest way to stay calm during a crash is to not enter the market in a fragile way. Calm is built before the storm. Now, in the next part of this video, we will get more practical. We will break down the exact thinking that helped him avoid the dot-com heat. We will build a simple circle of competence test you can use on any stock story you hear. We will build an owner note template you can write in 5 minutes so you stop buying with vibes and start buying with reasons. We will talk about business quality in plain words. What makes a business durable? What a moat looks like? And what warning signs show a business has no defense? And we will talk about valuation without turning it into math homework. Just simple rules that keep you from paying for perfection. Because the point of this story is not to feel smart about the past. The point is to protect your future. Bubbles will come again in new forms. And when they do, the market will offer you the same deal it offered in 1999. Excitement now, regret later. Your job is to choose the boring path on purpose, the path that lets compounding work, the path that keeps you from touching the fire. So let's build the tools, because the dot-com bubble was not only a market event, it was a thinking event. It showed what happens when people stop using rules. The first tool is the circle test. This is the test that keeps you from buying things you cannot hold. Here is the circle test in simple steps. Step 1. Can you explain the business in 1 minute to a friend? No buzzwords, no hype, just plain words. Step 2. Can you explain how it makes money? Not how the stock goes up, how the business gets paid. Step 3. Can you name the top 3 risks? Not the price might drop, real risks, like losing customers, a strong rival, high debt, a product that becomes outdated, a rule change. Step 4. Can you tell what would make you change your mind? A clear reason, a clear break point. If you cannot answer these, the business is outside your circle for now, and for now is not a shame. It is a safety rule. In 1999, many investors skipped this test. They did not know what they owned, so when prices dropped, they could not tell if it was a normal dip or real trouble. When you don't understand what you own, every drop feels like danger, and danger makes you sell at the wrong time. Now, you might say, but in 1999, nobody could understand these companies. They were new. That is exactly the point. When something is too new to value, the honest answer is I don't know. In markets, I don't know is a superpower, because it stops you from buying stories at any price. Most people can't say I don't know. They feel pressure to have an opinion. They feel pressure to join. They feel pressure to prove they are smart. That pressure creates bad buys. So the next tool is the owner test. This is how you shift from trader thinking to owner thinking. Ask this question. If the stock market closed for 5 years, would I still want to own this business? If the answer is no, you are not investing. You are trading. Trading is not always wrong, but during bubbles, trading becomes emotional. Emotional trading breaks compounding. Now, the owner test leads to another question. What makes a business strong enough to hold for years? That is where business quality comes in. So here is a simple business quality checklist. These are the boring questions that bubbles try to make you forget. 1. Do customers have a real reason to buy this, or are they just trying it once? 2. Are customers likely to keep buying in a weak economy, or is demand easy to cut? 3. Does the business make real cash, or does it burn cash and hope future growth saves it? 4. Does it have a moat, or can a rival copy it quickly? 5. Does it need constant outside money to survive? In the dot-com era, many companies failed this test. They had growth, but no cash. They had attention, but no loyalty. They had big dreams, but no moat. They were easy to copy. And they often needed new money to keep the lights on. In good times, that does not feel like a problem. In bad times, it becomes a wall. Now, let's slow down on the moat, because this is one of the most important ideas. A moat is what protects profits. Without a moat, competition eats the business like a school of fish. During bubbles, people focus on growth. They ignore defense. But long-term wealth needs defense. So here are common moats in plain words. Switching costs. It is painful for customers to leave. Network effects. The product gets better as more people use it. Cost advantage. The company can deliver cheaper than others. Brand trust. People choose it because they fear making a mistake. Scale and distribution. The company can reach customers easily. Others cannot. Now ask the moat question. What stops the next company from taking the customers with a better offer? If the honest answer is nothing, then you do not have a strong moat. And if you don't have a moat, you better have a great price. Which takes us to valuation. This is the part bubble markets hate, because valuation is the speed limit, and bubbles want no speed limit. In 1999, many people acted like price did not matter. They paid more and more, because the chart told them it was safe. But a price is not safe just because it is popular, so you need one clean valuation rule. Here it is. Never pay a price that leaves no room for error. That room is called margin of safety. Margin of safety is not a fancy formula, it is a mindset. It means you assume you can be wrong, and you plan for it. It means you do not pay for perfect growth forever, because nothing grows forever at high speed. Now, to keep this simple, we will use a valuation stress test. You ask 3 questions. First, what must be true for this price to make sense? Second, what happens if growth is slower than expected? Third, if I am wrong on one big point, do I still have a decent outcome? If the answers are everything must go right, then you are on thin ice. In the dot-com bubble, many investments required perfect outcomes, perfect growth, perfect margins, perfect competition, perfect execution. But the world is not perfect. So when normal problems arrived, prices collapsed. Now, you might hear people say, but technology really did change the world. Yes, it did. But here is the hard truth. A great invention is not the same as a great investment at any price. Planes changed the world too, but early airline investing was not always great for investors because competition crushed profits. The customer wins, the owner loses. That happens when moats are weak, so the calm investor was not saying no to technology. He was saying no to paying for dreams with no margin of safety. That is a key difference. Now let's talk about one more tool people bring up during this era. A big picture market measure. It compares the total value of the stock market to the size of the economy. When the market gets far above the economy, it can be a sign of stretched prices. It is not a crystal ball. It cannot tell you the exact top, but it can tell you when the room is getting hot. In the late 1990s, that measure was very high. It was a warning light. But most people ignored it because they were making money fast. And when money comes fast, people think the system is safe. That is another psychology trap. So let's name the traps clearly. Trap 1 is FOMO. FOMO says, if I don't buy now, I will miss my chance. But in investing, there is always another chance. There is always another price, another business, another time. The market is not a one-time door. Trap 2 is social proof. Social proof says, everyone is buying, so it must be right. But crowds can be wrong for a long time. And being in a crowd does not protect you from loss. Trap 3 is the genius effect. In bubbles, people get early wins. They feel smart. They take bigger risks. They believe they can time the exit. This is how one win turns into one big loss. Trap 4 is narrative addiction. Narrative addiction is when you fall in love with the story and stop checking the facts. Facts are boring. Stories are exciting. Markets punish excitement at the wrong price. Now, we are going to build a simple plan to fight these traps. It is called the 3-page system. Page 1 is your watch list, not a list of hot names. A list of businesses you understand. Next to each one, you write 3 lines. What it does, why customers stay, what could break it. Page 2 is your owner note. This is the note you write before you invest. It is short. 1 paragraph. What you believe. Why do you believe it? What would prove you wrong? This protects you from panic later, because when fear hits, your mind forgets why you bought. It starts making up new reasons to sell. The note keeps you honest. Page 3 is your valuation range. Not a perfect number, a range, a low end, a fair zone, a high end. The exact method can vary. The point is to have a sense of price discipline, so you don't buy just because the chart is green. Now, let's talk about the question many people ask. How did he avoid losing big in the tech crash? Part of the answer is simple. He did. Not overpay for hype. If you don't buy fragile things at fragile prices, you don't have to escape later. This is a huge lesson. Most people think safety comes from fast exits, but real safety often comes from slow entries. Slow entries mean you study first. Slow entries mean you wait for a fair price. Slow entries mean you stay inside your circle. Now, that does not mean you will never have losses. Prices move, markets fall. Even great businesses can drop, but when you buy with margin of safety and you understand the business, you are less likely to panic. And panic is what locks in the loss. So let's build the volatility script. This is what you tell yourself when prices fall. Say this: I don't own a chart, I own a business. Then ask, did the business break or did the mood change? If the business did not break, you do not need to rush. You review, you check facts, you follow your plan. And if the business did break, you don't panic either. You learn, you adjust, you protect your capital. Either way, you stay calm. Now, let's add one more rule that protects compounding. The rule is simple. Do not measure your skill by what happens this week. Bubbles trick people because bubbles reward bad behavior at first. They make risk look like skill. They make luck look like genius. They make speed look like intelligence. But investing is a long test. The score is not your weekly chart. The score is your process. So here are process goals that matter more than price. Did you avoid buying what you don't understand? Did you avoid paying for perfection? Did you write down your reasons? Did you stay within your risk limits? Did you avoid FOMO? Did you avoid panic? If you can do these things, you are building a system that can last. Now, we are halfway through the story. We've covered the tools: circle test, owner test, Moat checklist, margin of safety, the 3-page system, the volatility script. Next, we need to connect these tools to the heat of 1999 in a very clear way. Because the bubble did not pop in one day, it built up, it pulled in smart people. It made wild prices feel normal. So in the next part, we will walk through how the fire spread. We will talk about why new era thinking is so persuasive. We will show how people confused a real technology change with a safe investment at any price. And we will end with the most useful part: how to spot the same fire pattern today, not by guessing the top, but by watching behavior, your behavior, the crowd's behavior. Because in the end, bubbles are not only about numbers, they are about human minds. And if you can master your mind, you can survive any market mood. Now let's talk about how the fire spread. Because bubbles do not feel like danger while you are inside them. They feel like progress. They feel like a new world. They feel like a reward for being early. In 1999, the market was full of new era talk. People said old rules were dead. They said profits did not matter. They said growth was all that mattered. They said a website was enough to be worth billions. And the scary part is this: some of those companies were real. Some technology really was changing the world. That is what made the bubble so powerful. When something true is mixed with something exaggerated, people stop checking prices. They stop checking risks. They start buying the future like it is guaranteed. This is where the mind slips, because the mind loves simple stories. A simple story sounds like this: the internet will change everything, so any internet stock is a winner. But investing is not about the story. It is about the deal. A great story can still be a bad deal if you pay too much. In the late 1990s, prices went up so fast that many people forgot the deal part. They only saw the story part. And that is when the market becomes a crowd. A crowd does not ask, what is it worth? A crowd asks, will someone pay more tomorrow? That is a dangerous question because it turns investing into a game of passing risk to the next person. Now, here is one of the most important lessons from that time. Bubbles do not end because people suddenly become smart. Bubbles end because reality shows up. Reality shows up as slower growth, higher costs, stronger competition, a bad quarter, a new rival, a change in money conditions, a shift in mood. And when the mood shifts, the same crowd that rushed in begins to rush out. In 2000, the mood shifted. Some tech stocks started falling, then more fell. Then fear spread, and many investors did not know what to do because they never had a plan. They thought they were investing, but they were really chasing. So when the chase stopped, they froze. Some held and hoped. Some sold in panic. Some tried to buy the dip again and again with no idea what the business was worth. Many accounts got crushed. Now, it is easy to look back and laugh at the dot-com bubble, but that would be missing the point. The point is not that people were silly. The point is that the same human brain is still here, the same fear of missing out, the same need to fit in, the same urge to act when others act, the same belief that quick wins mean skill. And today, the crowd can form even faster Because social media moves faster than newspapers ever did. So the real lesson is not about 1 year. The real lesson is about patterns. Now, let's connect this to the warning idea in the title. The warning was not a magic prediction. It was a simple message about behavior. When people pay any price, they are playing with fire. Because high prices remove safety. High prices remove room for error. High prices turn small problems into big losses. That is what happened. Now, there is another piece many people talk about from that era, a big market measure. It looks at the total value of the stock market compared to the size of the economy. When the market gets very large compared to the economy, it can be a sign that prices are stretched. This measure is not perfect. It cannot tell you the exact top. It cannot tell you the exact bottom, but it can help you ask a simple question. Are we in a normal zone or a hot zone? In the late 1990s, the market was in a hot zone. That did not mean it had to crash tomorrow, but it did mean you should be careful. It meant you should raise your standards. It meant you should demand a better deal. It meant you should be extra strict about margin of safety. That is the key. When the room gets hot, you do not start playing with matches. You slow down. You add distance. You protect yourself. Now, let's bring it back to the calm investor's results in a truthful way. He did not avoid every dip in the market. No one does. But he avoided the worst damage from the dot-com fire because he did not chase the hottest names at the hottest prices. He avoided the need to escape later because he avoided the trap early. This is a lesson many people miss. They think the secret is timing the exit, but the bigger secret is how you enter. If you enter based on hype, you will need a perfect exit. If you enter based on value, you can survive bad weeks. Now let's make this useful for you, because the goal is not to win a history debate. The goal is to build rules you can use the next time the market gets loud. So here is a simple fire drill you can run on yourself. First, check your reason. Ask, why do I want to buy this? If the answer is mostly because it's going up, that is heat, not value. Second, check your understanding. Ask, can I explain this business simply? If not, it is outside your circle for now. Third, check the moat. Ask, what stops others from copying this and crushing profits? If you cannot name a defense, then you are betting on perfect execution. Fourth, check the price. Ask, does this price give room for error, or does it demand perfection? Fifth, check your emotion. Ask, do I feel rushed? If you feel rushed, pause, because urgency is often how fire spreads. Now let's talk about what to do. When the market is rising fast, this is when most people lose control. When prices are rising, people feel smart. When prices are rising, people feel safe. When prices are rising, people raise their risk without noticing. So you need a simple rule for green days. On green days, do less. This sounds strange, but it is true. When the crowd is excited, your job is not to match the crowd. Your job is to keep standards. So here is a green day script. Say, I don't need to chase. If it is a great business, it will still be a great business next year. Now let's talk about what to do when the market is falling. This is when fear tries to bully you. Fear will tell you that selling is safety. Sometimes selling is the right move, but panic selling is almost never the right move. So you need a red day script. Say, I expected prices to move. My plan is based on business facts, not mood. Then ask, did the business change or did the mood change? If the business did not change, you don't need to. Act fast. You review calmly. If the business did change, you still don't panic. You decide slowly with facts. This is how you keep control. Now, here is a key psychology lesson from the dot-com crash. Most people did not lose because they were too slow to sell. Many lost because they never knew what they owned. So when prices fell, they had no anchor. No anchor means you drift with the crowd. An anchor is your owner note, that one paragraph you write before you invest. It tells you what you believe and what would prove you wrong. It gives you a calm path in a storm. Without that, your emotions write the story in real time. And emotions are bad writers. They only write fear and greed. Now let's talk about a very modern problem. Social media makes bubbles harder to resist. In 1999, you had to hear tips from friends or TV. Today, you can get 1,000 hot opinions before lunch. That creates a new risk. Information overload. When you see too much, you stop thinking clearly. You start copying. you start reacting. So you need an information rule. Here it is. If the information does not change what you will do in the next year, it is probably noise. Noise makes you trade more. Trading more increases mistakes. Mistakes break compounding. Now, let's connect everything back to compounding, because that is the real goal. Compounding is not just about returns. Compounding is also about not getting wiped out. A big loss takes years to repair. A big loss can change your behavior. It can make you afraid to invest again. It can make you miss the recovery. That is why avoiding fire matters. You are not trying to be a hero. You are trying to stay in the game. Now, some people will say, but if you avoid hot trends, you will miss the next big thing. That fear is natural, but it hides a mistake. It assumes your only path to wealth is one perfect trend. That is not true. Most long-term wealth is built by holding good assets for a long time, at reasonable prices, with calm behavior. You do not need to catch every wave. You need to avoid drowning. Now, let's finish this with a simple set of decision rules you can carry with you. Rule 1. If you can't explain it, don't size it big. Rule 2. If you need perfection for the price to work, don't call it safe. Rule 3. If you feel rushed, wait. Rule 4. If the crowd is yelling, lower your volume, not your standards. Rule 5. Write your reasons before you buy, not after. Rule 6. Check the business, not the chart, when you feel fear. Rule 7. Think in years, not weeks. Now, here is the final lesson from the dot-com bubble. The crowd will always offer you excitement. Excitement feels like progress, but progress is often quiet. It is steady saving. It is patient investing. It is reading and waiting. It is buying quality at a fair price. It is holding through noise. It is refusing to pay any price just to feel included. That is why the warning mattered. Not because it predicted a date, because it exposed a behavior. And once you can see the behavior, you can protect yourself. You can spot when the room is getting hot. You can notice when you are being pulled by FOMO. You can step back. You can keep your margin of safety, and you can keep compounding alive, because in the end, the goal is not to touch every flame. The goal is to build wealth without getting burned.